4.1 million Americans turned 65 last year. That is the largest retirement wave in history, and right now, something is happening inside their portfolios that almost nobody is explaining correctly. Retirees are dumping bonds, not high-yield junk bonds, not speculative corporate debt. I'm talking about U.S. Treasuries, the so-called risk-free asset. The foundation of every pension, every 401k target date fund, every conservative retirement portfolio for the last 40 years. And they are moving that money into gold. If you only read the headlines, you would think this makes no sense. Yields are at 15-year highs. The Fed says inflation is cooling. Bonds are finally paying income again. So why would anyone sell? The mainstream answer is wrong. They will tell you it is volatility. They will tell you it is fear. They will tell you retirees are overreacting to short-term noise. That is true, but incomplete. In fact, it misses the entire mechanism. The real reason retirees are moving to gold has nothing to do with fear. It has everything to do with math. And once you see the math, you will understand why this is not a trend. It is a structural shift. Let me explain exactly what is happening. By the end of this breakdown, you will understand three things. First, why bond math breaks completely for someone with a retirement time horizon. Not in theory, in real dollar terms. Second, the invisible mechanism that is forcing yields higher regardless of what the Fed does. This is the piece most analysts miss entirely. And third, how gold became the only remaining risk-off asset for a generation of retirees who cannot afford to wait 10 years for bonds to recover. I have been watching macro markets for over 3 decades, and I can tell you with confidence, the bond market is sending a message that most people are misreading. The retiree moving to gold is not making an emotional trade. They are reading the clock. If you value this kind of system-level analysis, subscribe now, because what I am about to show you will change how you think about every single asset in your retirement portfolio. Let me start with the data so you can see this is not anecdotal. According to Morningstar and BlackRock's own Flow reports, U.S. bond funds saw net outflows of more than $200 billion over the last 18 months. The majority of those outflows are coming from accounts held by people aged 55 and older. At the same time, physical gold ETFs and allocated gold accounts have seen the largest weekly inflows since 2020, and the demographic profile is identical, 55 plus. Now here is where this gets interesting. When you ask a traditional financial advisor why this is happening, they will give you a standard answer. Rising yields create price volatility in existing bonds. Retirees are sensitive to volatility, so they are rotating into gold, because gold has historically been less correlated. Ansri diakisais chamastas kast wernsais. That sounds reasonable, but it is wrong, because volatility does not explain the timing. Bond volatility has been elevated since 2022. The outflows did not start then. They started accelerating in mid-2024. Something changed. Let me tell you what changed. The average retiree today has a time horizon. That horizon is not 10 years. It is not 20 years. For someone who turned 65 last year, the average remaining life expectancy is about 18 years. But here is the critical piece. Their withdrawal schedule is front-loaded. Healthcare costs, long-term care, the first decade of retirement consumes the majority of their portfolio. That means a retiree cannot wait out a 10-year bond cycle. If they buy a 10-year treasury at par and yields rise, the market value of that bond drops. If they need to sell in year 3 to pay for expenses, they realize a permanent loss. Now zoom out. The bond market has just gone through the sharpest yield increase since 1981. A 10-year treasury purchased at the start of 2022 lost approximately 18% of its market value. Not because of default risk, because of interest rate risk. That loss is not a paper loss for a retiree. It is a realized loss the moment they need to withdraw. Gold has no such mechanism. Gold has no maturity date. Gold has no coupon. You do not get forced into a loss because the market reprices the asset. You hold it, or you sell it, on your timeline, not the bond markets. That is the first layer of the mechanism, but it is not the deepest. Stay with me. because Chapter 2 is where the real math begins. Now let me walk you through exactly how this works. Write this down, because most financial media will never explain it this clearly. Step 1. The inverse relationship. When interest rates rise, existing bond prices fall. This is not opinion, it is arithmetic. A bond paying a fixed coupon becomes less valuable when new bonds pay a higher coupon. The market reprices the old bond downward until its yield matches the new rate. For a 10-year treasury, every 1% increase in yield reduces the bond's price by approximately 8%. That is the duration effect. Longer maturities, larger losses. Step 2. The retiree's withdrawal schedule. Here is what the models do not tell you. A 65-year-old retiring today does not withdraw their entire portfolio on day one. They withdraw annually, typically 4 to 6% of the portfolio value per year to cover living expenses. But here is the trap. If bond prices have fallen, the retiree has two choices: sell the bond at a loss or sell something else. If everything in the portfolio is correlated, if stocks are also down, the retiree has no good option. They are forced to sell at the worst possible time. This is called sequence of returns risk, and it is the single biggest destroyer of retirement portfolios. Step 3. The math of forced selling. Let me give you a concrete example. A retiree has a $1 million portfolio, 50% in bonds, 50% in stocks. They need $40,000 per year for living expenses. Now imagine bonds fall 8% in 1 year. The bond portion drops from $500,000 to $460,000. Stocks fall 10%. The stock portion drops from $500,000 to $450,000. Total portfolio, $910,000. The retiree still needs $40,000. To raise that cash, they must sell assets at the bottom. Every dollar they sell today is a dollar that will never compound again. This is not a theoretical problem. This happened to real retirees in 2022, and it is happening again right now. Step 4. Why gold breaks the cycle. Gold has no duration. Gold has no coupon. Gold has no maturity date. That means gold has no forced relationship to interest rates. When yields rise, gold can fall. It can rise. It can trade sideways. But here is the critical difference. You are never forced to sell gold at a specific moment because a clock is running out. If gold is down 20%, you wait. You do not sell. Because gold has no maturity, there is no penalty for holding. The asset waits for you. This is the mechanism most people miss entirely. Gold is not a hedge against inflation in the way textbooks describe. Gold is a hedge against forced liquidation. It is the asset that lets you choose your selling window instead of the market choosing it for you. Step 5. The accelerating feedback loop. Now here is where this gets dangerous. As retirees sell bonds to move into gold, bond prices fall further. As bond prices fall, yields rise. As yields rise, more bonds in other portfolios lose value, and those other portfolio holders, pension funds, endowments, foreign central banks, also start selling. Each sale reinforces the next. The mainstream narrative says gold is rising because of inflation fear. That is not wrong, but it is incomplete. The deeper truth is that gold is rising because bonds are breaking the retirement contract, and retirees are the first ones to notice. Let me show you why almost everyone is misreading this signal. There are 3 myths circulating right now, and each one is keeping ordinary investors from understanding what is actually happening. Myth 1: bonds are safe because they always pay back par at maturity. That is true, but incomplete. Yes, if you hold a treasury to maturity, you get your principal back. But that assumes you can hold to maturity. A retiree with a 10-year bond purchased at age 65 would get par back at age 74, 75. That is fine if they never need the money before 75, but they do. Healthcare costs spike in the first decade. Long-term care averages over $60,000 per year. The average retiree withdraws more in years 1 through 10 than in years 11 through 20, so the hold-to-maturity argument only works if you have separate cash reserves for the entire first decade. Most retirees do not. Myth 2: higher yields are good for retirees because they increase income. This is the most dangerous myth. Higher yields are good for new money. They are terrible for existing money. A retiree who bought a bond at 2% and now sees yields at 4% has not gained income. They have lost market value, and if they need to sell, that loss is permanent. Even if they hold to maturity, they have locked in below-market yields for years, while inflation continues to run. The real return after inflation may be zero or negative. A 4% nominal yield with 3% inflation gives you 1% real. That is not wealth preservation. That is slow erosion. Myth 3. Gold is too volatile for retirement portfolios. Let me show you why this is backwards thinking. Yes, gold has volatility. In any given year, gold can move 20 to 30%, but volatility is not the same as risk. Risk is the probability of permanent loss. What is the permanent loss risk in a 10-year treasury bought at 2%? If inflation averages 3% over that decade, the real loss is approximately 10% of purchasing power. That is a guaranteed mathematical loss. Gold has no guaranteed loss. Gold has price volatility. But over a 10-year rolling period, gold has never gone to zero. The same cannot be said for bond purchasing power in a rising rate environment. The retiree is not choosing between a stable asset and a volatile asset. They are choosing between an asset with guaranteed real losses and an asset with uncertain but historically protective returns. That is a very different decision. Now zoom out, because this is not the first time bonds have failed retirees. Now, let me zoom out, because if you think this is new, you are missing the full picture. In 1973, a retiree who bought a 10-year treasury bond earned approximately 6.5%. Inflation that year was over 8%. The real return was negative. By 1979, inflation hit 13%. Bond yields lagged the entire decade. They called bonds certificates of confiscation back then, not because bonds defaulted, because bonds silently destroyed purchasing power year after year. Then something changed. In 1981, Paul Volcker raised rates to 20%. Bond yields peaked, and for the next 40 years, bond prices rose as rates fell. From 1981 to 2020, bonds delivered one of the greatest bull markets in financial history. Here is what most people forget. That 40-year bull market was not normal. It was the anomaly. The period from 1981 to 2020 was defined by falling inflation, falling rates, and a demographic tailwind as baby boomers entered their peak earning and saving years. Every one of those trends has now reversed. Inflation is stickier than the Fed admits. Rates are no longer falling, and the demographic wave has flipped. The same baby boomers who fueled the bond bull market are now retiring and selling. Write this down. The bond bull market is over. And most portfolios are still built for a world that no longer exists. Now let me show you what happened the last time we faced a similar structural shift. From 1966 to 1981, the S&P 500 went essentially nowhere in real terms, but gold went from $35 per ounce to over $800. That is a 2,300% return, not because gold changed, because the monetary system changed, because confidence in paper assets broke. Because retirees and institutions alike realized that bonds and stocks were not delivering the safety they promised. We are not replaying 1979 exactly, but the mechanism is the same. Central banks are trapped. Debt levels are higher than ever. And the Federal Reserve cannot lower rates without reigniting inflation. They cannot raise rates without breaking the Treasury market. They have no good options. That is the structural framework retirees are sensing. They do not need to read central bank meeting minutes. They just look at their portfolio statements. They see bond losses. They see inflation still running above their yield. And they make a rational decision. Gold is not a bet on disaster. Gold is a bet that the last 40 years were the exception, not the rule. Now let me give you exactly what to watch next, because this story will not unfold all at once. It will unfold in signals. If you want to know whether this rotation accelerates or reverses, stop watching gold. Watch these 4 things instead. First, watch the 10-year Treasury yield. Above 4.5%, the math gets brutal. Every additional half point destroys approximately 4% more bond value. When yields cross 5%, you will see a second wave of selling from retirees who hoped yields would reverse. They will not wait longer. Second, watch the Fed's balance sheet run off. The Fed is shrinking its holdings of treasuries by allowing bonds to mature without reinvesting. That removes a massive buyer from the market. Every month they do this, yields face upward pressure. Watch for the moment the Fed stops. That is when they admit the system is breaking. Third, watch COMEX gold inventory. COMEX is the primary gold futures exchange in the United States. When physical inventory drops below certain levels, it signals that paper gold and physical gold are decoupling. Retirees moving into physical gold ETFs are already straining this system. Watch the weekly inventory reports. They will tell you when the paper market is failing. Fourth, watch foreign central bank gold purchases. China has bought gold for 18 consecutive months. India, Turkey, Poland are doing the same. They are not buying for short-term returns. They are buying because they see the same bond math retirees see. When central banks are on the same side of a trade as retail retirees, pay attention. Those four indicators will tell you everything the headlines will not. You do not need to predict the future. You just need to watch the mechanism unfold in real time. Now let me close with something important. Here is the truth most people will not tell you. The retiree moving to gold is not making a political statement. They are not gold bugs. They are not conspiracy theorists. They are reading their portfolio statement, looking at their life expectancy, and doing simple math. Bonds promise safety but deliver forced selling at the worst possible time. Gold promises nothing except that it will be there when you need it, on your timeline, not the markets. That is not a trade. That is a structural shift. In 40 years of watching markets, I have learned one thing repeatedly. When ordinary people start behaving differently than the models predict, the models are wrong. The models say retirees should hold bonds. Retirees are selling bonds. The models will adjust. But not before more losses happen. You do not need to sell everything today. But you do need to ask yourself one question. If your bond portfolio loses another 10% while you are withdrawing for living expenses, what is your plan? Because the mechanism I just showed you is not finished. It is just getting started. The retiree moving to gold is not making a bet. They are reading the clock.